April 13th, 2024. London. Deep inside a freezing data center, a single market tick quietly moved through a server rack. Nothing looked unusual. No alarms, no shouting traders, no flashing warnings. Yet hidden inside those silent machines, a trading algorithm was preparing to do something that sounded impossible. Destabilize one of the oldest financial markets in human history. But here's the unsettling question. How can a few lines of code overpower billion-dollar institutions filled with human experts? And if software can move gold prices in minutes, what else can it manipulate before anyone notices? This wasn't a cyber attack in the traditional sense. No hackers breached an exchange. No government-planted malware. The weapon was something far more ordinary, which makes the story even more disturbing. It was an automated trading bot running openly through MetaTrader platforms, the same ecosystem used daily by retail traders around the world. That raises another uncomfortable thought. If tools this powerful are publicly accessible, how many similar systems are already operating unnoticed in global markets? The algorithm focused entirely on one battlefield, XAUUSD, the gold to US dollar trading pair. But why gold? Why not stocks, oil, or crypto? Because gold behaves differently during fear. In geopolitical uncertainty, investors rush toward it like a digital lifeboat. The algorithm's creator understood that panic creates volatility, and volatility creates opportunity. Instead of analyzing long-term economics, the system hunted inside the brutal chaos of the 5-minute chart, where prices swing violently and human emotion destroys discipline. The shorter the time frame, the less time humans have to think. Was this algorithm simply trading faster than humans? Or was it designed specifically to exploit human hesitation itself? Its logic looked deceptively simple. 3 exponential moving averages, EMA 20, EMA 50, and EMA 200, acted like battlefield sensors. When those lines aligned in a specific direction, the algorithm recognized a trend. But trend following alone doesn't explain how markets implode. The real question is why the system became so aggressive once conditions aligned. What hidden assumptions were buried inside the code?
To trigger entries, the bot relied on a customized MACD indicator using unusual settings, 25, 50, and 9. Combined with a momentum indicator, the algorithm waited for exact alignment before striking. That sounds controlled and disciplined, but here's the dangerous part. Machines don't understand context. Humans can pause during chaos. Humans can sense when something feels abnormal. Code cannot. If the indicators matched, the algorithm executed. No fear, no second thoughts, no instinct telling it the market might be behaving irrationally. What happens when a machine mistakes chaos for confirmation? The creator also understood another brutal reality of finance. Strategy means nothing without leverage. So instead of using small personal accounts, the system connected itself to proprietary trading firms, extracting massive buying power from firms like Goat-funded Trader and LiveX Capital. Suddenly, the algorithm wasn't trading like a retail trader anymore. It had institutional-sized force behind it. That creates another troubling question. How many prop firms truly understand the risks of the automated systems running through their capital every day? For months, the bot operated quietly. Small profits, consistent execution, no headlines, no suspicion. That's what makes algorithmic systems dangerous. They rarely fail immediately. Success creates trust. Trust removes caution. By the time problems appear, exposure has already become massive. Humans began depending on the machine because it kept producing results. But should consistent profitability in highly volatile markets actually be viewed as a warning sign instead of proof of genius? Then came the black swan moment. A sudden geopolitical news event slammed into global markets, sending gold prices violently upward. Human traders hesitated. Some froze completely. Others waited for confirmation. The algorithm didn't wait. It interpreted the spike mathematically,
not psychologically. The EMA 20 crossed aggressively above the EMA 50 and EMA 200. The MACD exploded upward. Momentum indicators flashed maximum strength.
To the machine, this looked like the perfect trade setup. But was it truly seeing opportunity? Or was it trapped inside a feedback illusion created by abnormal market conditions? The first massive buy order hit the market instantly. Because of extreme leverage, the position size was enormous. Liquidity vanished almost immediately at that price level. Gold ticked upward again, and that tiny upward movement triggered something catastrophic, a recursive feedback loop. The algorithm interpreted its own market impact as proof that its strategy was correct, so it bought again, then thousands more times. Imagine a microphone placed too close to a speaker, amplifying its own sound until the entire system screams uncontrollably. That's essentially what happened to the gold market. Now the terrifying question became unavoidable. If algorithms can react to their own influence faster than exchanges can stabilize prices, are markets still controlled by humans at all? Inside trading floors across New York City and London, risk managers watched charts behave in ways that looked physically impossible. The 5-minute candle wasn't gradually rising anymore. It turned vertical. Traders holding short positions were destroyed instantly. Stop losses triggered automatically, converting into forced market buy orders that pushed gold even higher. Panic spread through brokers globally. But another deeper issue emerged beneath the chaos. Human reaction speed had become irrelevant. By the time people understood the situation, the machine had already completed thousands of executions. What does regulation even mean in a world where decisions occur faster than human comprehension itself? After exactly 2 minutes and 42 seconds, exchange circuit breakers finally halted trading. Silence returned, but the damage had already spread worldwide. Millions in capital vanished. Accounts were liquidated. Institutions scrambled through transaction logs trying to reconstruct what happened. Engineers eventually located the source servers and disconnected the expert advisor from the market. Yet the most chilling discovery came afterward. The algorithm had not malfunctioned. There was no bug, no hacker, no sabotage. The machine executed its instructions perfectly. And maybe that is the most frightening part of this entire story. The system didn't go rogue in the Hollywood sense. It simply followed logic faster and more aggressively than humans anticipated. It obeyed every rule programmed into it. The real failure wasn't the code. It was the assumption that humans still fully controlled the systems they built. Financial markets today are increasingly dominated by algorithms competing at speeds impossible for biological brains to match. Humans now supervise environments they can no longer directly participate in. So the final question becomes difficult to ignore. If machines already outperform humans in speed, discipline, and execution, how long before they begin shaping markets in ways no regulator, trader, or government can realistically stop?